Backtesting is one of the most misunderstood, yet most powerful practices in trading, not because it guarantees success, but because it strips away illusion. Many traders avoid backtesting because they fear what it might reveal. Others do it mechanically running numbers without extracting real insight. In reality, backtesting is not about proving that a strategy works. It is about understanding how it works, when it works, and just as importantly, when it fails. Without this understanding, confidence in a strategy is borrowed from hope, not earned from evidence. At its core, backtesting means applying a clearly defined trading strategy to historical market data to see how it would have performed. This sounds straightforward, but the implications are profound. Backtesting forces precision. Vague ideas cannot be tested. Buying when it looks strong or selling when it feels overbought collapses under scrutiny. To backtest rules must be explicit entry conditions, exit conditions, stop placement position, sizing time, filters, and markets traded. This process alone already improves many traders because it exposes how much of their decision-making was previously based on intuition rather than structure. One of the greatest benefits of backtesting is that it separates strategy quality from execution quality. Many traders abandon good strategies because of poor execution under pressure. Backtesting helps answer a critical question: is this strategy fundamentally flawed, or did I fail to follow it? When a trader knows that a strategy has positive expectancy over hundreds of trades, short-term losses become tolerable. They are no longer personal failures. They are statistical variants. This shift alone can dramatically improve discipline. Backtesting also reveals the true personality of a strategy. Some strategies win often, but with small gains and occasional large losses. Others lose frequently, but deliver large winners. Some perform well in trending markets and poorly in ranges. Others do the opposite. Without backtesting, traders often discover these characteristics emotionally during live trading, when mistakes are expensive. With backtesting, these traits are known in advance, allowing the trader to decide whether they can psychologically tolerate the strategy before risking capital. Another critical insight from backtesting is drawdown behavior. Most traders obsess over win rate or net profit, but professionals care deeply about maximum drawdown recovery time and equity curve smoothness. A strategy that doubles an account but experiences a 60% drawdown along the way may be mathematically attractive, but behaviorally impossible for most people to execute. Backtesting reveals whether a strategy's pain profile matches the trader's tolerance. Mismatch here is one of the most common causes of failure. Backtesting also helps eliminate false confidence. A few recent wins can convince a trader that they have found an edge. Backtesting across different market conditions, volatility regimes, and time periods often humbles that belief. Strategies that look brilliant in 1 year may fail quietly over a decade. This does not mean the strategy is useless, but it does mean it is conditional. Knowing those conditions allows for adaptation rather than blind persistence. It is important to understand that backtesting is not a crystal ball. Markets change, regulations shift, liquidity evolves. A strategy that worked in the past can stop working. This is where many critics dismiss backtesting entirely. This dismissal misses the point. Backtesting does not predict the future. It calibrates expectations. It tells you what kind of outcomes are normal, what kind of losses to expect, and how long patience may be required before results appear. That calibration is invaluable. Another overlooked benefit is that backtesting builds trust in rules. Trust is essential in trading. Without it, hesitation creeps in. Stops are moved, exits are delayed, and size is adjusted emotionally. When rules are backed by evidence, following them becomes easier. You are no longer obeying a system blindly. You are executing a plan you have seen work over time. This trust reduces decision fatigue and emotional exhaustion. However, backtesting can also be misused. Over-optimization is the most common trap. Traders tweak parameters endlessly to maximize historical performance, creating strategies that fit the past perfectly and the future poorly. This curve fitting creates fragile systems that collapse in live conditions. Effective backtesting seeks robustness, not perfection. A strategy that performs reasonably well across many conditions is more valuable than one that performs exceptionally in a narrow slice of history. Data quality and realism matter as well. Ignoring transaction costs, slippage spreads, and execution delays produces inflated results that vanish in live trading. Honest backtesting includes friction. It assumes imperfect fills and conservative assumptions. The goal is not to impress yourself with numbers, but to approximate reality closely enough that surprises are minimized. Perhaps the most valuable aspect of backtesting is psychological preparation. Seeing hundreds of historical trades unfold teaches patience in a way no lecture can. You see long losing streaks followed by recovery. You see periods of stagnation. You see that profitability is not linear. This exposure conditions the mind to accept what trading actually feels like, not what marketing promises it should feel like. Backtesting, when done properly, transforms trading from gambling into research. It moves the trader from reactive participant to informed operator. It doesn't remove uncertainty, but it reduces ignorance. It doesn't guarantee profit, but it increases the probability that when profit arrives, the trader is still present to receive it. As powerful as backtesting is, it only delivers its full value when done with the right intent, the right methodology, and the right expectations, because the same tool that builds confidence can also create dangerous illusions, if misapplied and understanding how to backtest correctly. What mistakes to avoid and how to translate backtest results into live trading behavior is exactly where we need to go next. By examining how to backtest a trading strategy correctly and turn the results into something that actually improves real trading, because numbers alone do not change behavior, interpretation does. The first rule of effective backtesting is clarity before calculation. Every rule must be defined so precisely that two different people would execute the same trades when looking at the same chart. Entry-exit, stop-loss position size time filters, and market selection must be written down before any data is examined. If rules are adjusted while looking at results, the test is already compromised. Backtesting is only honest when the strategy exists independently of its outcomes. The second rule is to test across variety, not convenience. A strategy tested only on one market, one time frame, or one favorable period is not proven it is staged. Robust backtesting includes different market regimes, trends, ranges high volatility, low volatility crises, and calm periods. The goal is not to find perfection, but to see how the strategy behaves when conditions are less than ideal. A strategy that survives stress is more valuable than one that shines briefly. Transaction realism is non-negotiable. Includes spreads, commissions, slippage, and imperfect fills. Assume worst reasonable execution rather than best. If a strategy only works under ideal conditions, it doesn't work. Conservative assumptions protect you from false confidence, which is one of the most dangerous byproducts of backtesting. When reviewing results, focus on behavioral metrics before profit metrics. Maximum drawdown length of drawdowns, losing streaks, and recovery time matter more than net return. Ask yourself a hard question: could I actually trade this through the worst historical period shown here without breaking my rules? If the honest answer is no, the strategy needs adjustment regardless of how profitable it looks on paper. Avoid over-optimization by embracing parameter stability. Small changes in inputs should not cause massive swings in results. If moving a stop by one candle or adjusting a moving average slightly destroys performance, the strategy is fragile. Robust strategies degrade gracefully. They do not collapse instantly. This is one of the clearest signs that a backtest is describing a real edge rather than a statistical accident. Once a strategy passes, backtesting the transition to live trading must be gradual. Forward testing on a demo or very small account bridges the gap between historical logic and real-time execution. This phase reveals execution errors, emotional responses, and slippage that backtesting cannot fully capture. Skipping this step is a common and expensive mistake. Confidence must be earned twice, once in data, once in practice. Perhaps the most overlooked step is expectation alignment. Backtesting tells you what is normal for a strategy, how often it loses, how long it stagnates, how uneven progress feels. Internalizing this normality is what allows discipline in live trading. When reality matches expectation, patience survives. When it doesn't, emotion takes over. Backtesting is preparation, not reassurance. In the end, the true power of backtesting is not statistical. It is psychological. It transforms fear of the unknown into respect for probability. It replaces hope with evidence. It teaches traders that success is not about avoiding losses, but about surviving them repeatedly without abandoning a proven process. Traders who backtest correctly stop chasing strategies. They start building businesses. If this discussion helped you see backtesting as a discipline rather than a shortcut, consider subscribing to stay with these long-form conversations, focused on building skill through realism, and leave a comment sharing what you find most confusing about backtesting, because the questions you struggle with often point directly to the next improvement that matters most.